Hey everybody, it's Pete. Welcome to today's episode of Stocks for Breakfast. I guess you could also call this an episode of stock trading for beginners. A few videos back, I mentioned way back in 2000, 2001, when I first started trading, specifically in 2001, after I had a little bit of experience, we had stocks that we called indicator stocks, which they were so big in the market and especially big in the NASDAQ back then, it would actually move those stocks first because they were kind of the must own stocks if the market was going to move. And specifically back then, Cisco was a monster part of the NASDAQ back then, which is primarily what I traded uh, mostly from 2000 to 2003. I really didn't start trading listed stocks or New York Stock Exchange stocks until after 2003, and futures actually. Um, so what I wanted to touch back on again, I think it's a really good uh, structural lesson. I didn't want to say beginner or basic lesson because it's not really the truth because it's something that I use every day. It's just a fundamental lesson. That's actually probably a better way to word it. Um, Getting to the point where you can look at a chart every day and say, I know exactly what I'm looking at is key, right? Um, but I want to get to the point where you can look at a chart and spot money making opportunities, right? The last thing you want to be is the greatest chart reader in the world. I keep saying that over and over again because it's the truth. You see, I got books everywhere. You don't want to be the greatest chart reader on the planet. You want to strive to be a profitable trader. Big difference. So what we're going to talk about today is we're going to talk about how heavily influenced my trading is from reading the market, then going down to reading individual sectors. Wow, my voice just came back. Reading individual sectors, and then how those individual sectors break down to and again, I'm going to use this in context, what I would call easier trades, because the market and those individual sectors, or you might call them indices, industries, or ETFs in this case, we're going to take a look at today, and how they set up trades that are the highest likelihood for following through in the direction that you see. So you'll notice every single day I start out with by going straight to the SPY ETF. And there's a reason for that. I want more money on the same side. I want more money doing exactly the same thing. I want to say, wow, 500 stocks, spot, right? S&P 500 ETF, 500 stocks are doing the same thing. They're clearly well bid. They clearly have order flow. They clearly have room to go. Or I want to be able to tell in an instant, wow, there is massive indecision here right now, and we can't get out of our own way. And a lot of stocks look that way, right? So really, to be a great trader, to be somebody who pulls money out of the market every single day, and again, I know I've said in the past we should set monthly goals, not daily goals. You want to go to the market every day expecting to make money. But in order to do that, you need a structure every day to say, okay, I can tell exactly what's going on right now, and that is telling me what to do before this day and before this week unfolds. So whether you're day trading or swing trading, it doesn't matter. You could do the same exact thing on the weekly charts or the monthly charts. You might look at the weekly chart. For example, we'll take a look at the SPY right now, and say that this is absolutely not as clear as it was 2 weeks ago, 3 weeks ago, when we were in the midst of that 5-week rally. Now something has changed. I need for the market, in this case the SPY, I don't know why I keep doing that, to resolve itself and then become more obvious so I can hop on board. I got some really nice emails yesterday about the quote that I threw out there yesterday, so I'm going to actually give it to you again, which is simply pick a side, then pick a spot. Picking a side on the order flow, determining where it's super obvious, and only then getting involved is job number one. The other part of our job is if you determine it's not obvious, you dial back and you say, okay, there's no edge for me here. I don't want to take risk because I have one-to-one. Risk $3 to make $3. That's dumb. You don't want to risk one-to-one. One-to-one risk-reward ratio makes you a break-even trader. Nobody wants to be a break-even trader. And again, I'm going to keep drilling it home. We want one thing. We want to make money. We want to see our account grow steadily. Now, do you want to grow your account blazingly fast? Sure, you can, but let's learn how to make money first. And then as you gain more experience, you can learn and know actually even better, you'll know when you should be pushing it. So for example, in this environment right now, I have scaled back my size dramatically and scaled back my activity level because for me, for my style of trading, which again, we've been covering this, is I've been taking quicker profits. I haven't been holding as many overnight trades. And instead of building positions into a pause, I've mostly been taking profits off the table for, let's say, 70 to 75% of my position, and then letting the balance keep going, for lack of a better way of putting it. I'm looking to see if I can squeeze a little bit more out of the balance. So again, I get emails and everybody's like, what am I missing? What am I missing? And quite honestly, you're not missing a lot. There's earnings related opportunities now that have been taking off and giving us some good opportunities. And, we could touch on those in the next video when we do best stock picks. But I want to go to the charts, and I want to do something really fun that, I spent last night thinking about what would be the simplest way for somebody to really get a grasp on what I mean by I trade mostly market stocks, where I get a super good reading on the market, and then I find stocks that I think will move with the market. So we're going to go to the charts. But first, we're going to talk about a trade that we talked about from last week that set up just really, really well, where it did something opposite of what the market did in one day. And then we came into the next day saying, if the market's bullish, we're going to be trading the stock, or we really like the stock because it traded contra to the market, which last Friday, the market was weak. This particular stock was strong, and this stock had a really, really good bounce on Monday, and it was a really good trading opportunity. So we're going to take a look at those charts, and then we're going to get into something what I think is pretty exciting, actually. So right over here is what I'm talking about. This was last Friday, so you can see on the bottom there, it's May 1st. Market closed, well offered, closed on its lows. So what I did was I ran a quick scan for which stocks closed positive on Friday and which stocks had order flow, bullish order flow, and closed in the upper 10% of their range. And I came up with CRWD as the stock that met all of the criteria here on that Friday. And I said, okay, if the market finds some buyers on Friday, if the market trades above the open, if we're net positive, this will be the first stock I'm going to go to because it had buyers when the market was weak. And you can see we got a one-day trade out of this into resistance that was just, again, I'm going to use it in the context of education. It was an easy trade and an easy profitable trade because I put in the work to recognize the stock had relative strength compared to the relative weakness of the market. If the market was down and the stock was trading below the, was trading well offered, I wouldn't have even touched it. But right out of the gate, it traded well, and the open 68.35. The high was where is the high? 73.67. So roughly a $5 easy picking day, just from doing some simple relative strength. So the other thing I want to get into, which I think is kind of cool, this is what I mean in the market. For me right now, this is the image that I have in the market. Until it gets out of this window, you can clearly see that the upside potential, if I'm trading market stocks, or even if you're just trading S&P futures, which a lot of people in our coaching program are doing, you can see that there's slim pickings. It's very frustrating. You're not getting follow through. And by the way, if you're new to the channel, absolutely please click down, subscribe, click like, leave a comment. But you can see here, I don't use the high and I don't use the low. I look for the price, and this is real tape reading. I look for the price that is struggling to get above or below and stay there. And what a great example the last 2 days that I have the price nailed. It got above here and pulled back in again. That's the price. We have to get out of this window and stay there. So if you feel like you're getting a read on the market lately and you're frustrated, it's not you, it's the market. The market has been challenging for 4 weeks. We need to let the market tip its hand and then hop on board for that little bit bigger picture. So we said we're going to see the same thing on the weekly charts. If you're swing trading, think about what the market has done. We went from well bid, right, to inside candle, to bearish U-turn, to now we're forming a well offered candlestick. So clearly not the same as it was here. The picture has changed. So the next part of what I want to get into is, to me, it's a super fun exercise. So let's say, for argument's sake, you agree that you want to trade the SPY and you use that as a proxy for whether the market's going up or down, right? Then what I'll do is I'll go over to Yahoo Finance. So again, I'm using all free stuff, so you can do this without worrying about paying for anything. And you're going to click over, you're going to type in SPY in this case, and you're going to go to holdings. You're going to scroll down a little bit, and this is really cool. You can take a look at the major sector weightings in the SPY. So if the SPY is super obvious, you would then find stocks within those sectors to trade. So that's one way of doing it. A much, much simpler way of doing it is now you go down to the holdings and the top holdings of stocks in the S&P 500, and you would look to see which of those stocks meet your volatility criteria, which stocks you can afford to trade, and when the market's obvious, these stocks should move with the S&P. And we could do the same thing with the Qs. Same exact thing, QQQ, go over to holdings. You take a look and see what are the highest weighted sectors. So again, how would you take that? Then you would go into, let's just say we go over to communication services. You go over to FinViz, again, another free service. You would go over to the groups sector, and then you would break it down even further to take a look and see where they are within those sectors. So that's how you do in the Qs. And I scroll down a little bit further, and you can see the top holdings of the Qs. So if the Qs moves, the highest weighted stocks in that sector are very likely to move in that same direction as well. And the last example we'll do here is the XLF, the financial sector. So again, you just type in XLF, you go to holdings, you take a look at the highest weighted sectors. If you want, you can go find stocks in those sectors. Obviously, it's 100% financial services. And then you take a look and see which stocks are actually the highest weighted holdings and see which of those meet your personal criteria. So if we pull up the XLF, and if the XLF is trading well, which ironically now is forming well-offered candlestick, we had a failed breakout in a well-offered candlestick, you go down to the individual charts, and just to prove my point here, which is kind of cool, without even looking, the chart of JP Morgan looks almost identical to the chart of the XLF. So it's a great way to find opportunities with conviction. And I say with conviction because the very fact that you're looking at an ETF is kind of hedged in itself, because the ETF is a bunch of stocks that you're investing in or trading that represent that sector. So instead of finding the one stock, you're basically hedging your bet by diversifying by buying an ETF. But if you want a little bit more bang for your buck, you could get in there, watch the global sector. Global is not the right word. Watch the sector of the ETF itself, and then find the individual stocks. So you're going top down from what's the major market indices doing to individual. And I just gave 3 as an example. Obviously, there's a lot more. Breaking it down to individual sectors that you might want to trade, then the holdings within that, and you can find some easier opportunities. So hope that gives you some ideas to do a little bit of homework at night and over the weekend to find some good opportunities and some easier opportunities that you can really wrap your head around, because I think one of the biggest problems is overwhelm in the market, where there's just too much to look at. And I will tell you this, you don't need to look at everything. You need to look at what you feel comfortable trading and master that, whether it's a sector, whether it's a group of stocks, whether it's 1 or 2 patterns. You do that over and over and over again, the stock's not going to wear out. The only thing you'd ever have to worry about is they become too expensive for you to trade, or they become illiquid or out of play because they keep going down and there's just no opportunity, where the average true range keeps shrinking. So hope that gave you some good ideas. The relative strength play is a great one that you could use on a daily basis, every day, literally at the end of the day, every day. And the one I just covered there with the ETFs is a super simple way for you to develop your own list, where you watch that ETF and then trade the individual stocks within that ETF. So thank you for joining Stocks for Breakfast today. Click down, click like, click subscribe. And if you have any questions, leave them in the comments. Have a great day, everybody.